Next year, year 2019, will mark the 50th anniversary of catastrophe models. Over the past years, they have evolved into the industry standard, and they have become an integral part of our everyday professional lives. So how reliable they are actually. I thought we could use this opportunity for a recollection how the development of catastrophe models has transformed our understanding of natural catastrophe risks and how it has transformed the entire insurance and reinsurance industry. The commercialization and growth of catastrophe models occurred in 1980s, but it was Dr. Don G. Friedman who deserves a credit for being an originator. And already in 1969 he wrote his paper about the computer simulation of earthquake hazard, and several years later he described his work as providing an order of magnitude measure of overall loss potential associated with natural hazards. And this simple humility is worth emulating, I think, and in connection with model reliability, it actually says everything. In my short presentation, I would like to focus on the 4 following topics, always in connection with model reliability. First, back to the basics. What is a model, and what is a catastrophe model in particular? Good analysts always learn from the history. So what are the most important lessons learned since the introduction of the first commercially available models in 1980s? How did they evolve, and what's next on the horizon? Catastrophe models are very precise, but not always very accurate, as we learned. So I would like to discuss very briefly also the modeling uncertainty and how can we cope with the uncertainty. It's always a challenge to do it without emptying the room, but I will do my best. So in a literature you would find at least a dozen different definitions of a model, but they would have one thing in common, and that would be the keyword simplification. Models are all simplifications. So one can already see a problem with the models, that they are all wrong. And they are known to be wrong, but some of them are fairly useful. And over the years they have become very powerful. But like most of the powerful tools, they must be used and implemented responsibly and accurately in a manner which is consistent with its construction. I apologize if it's too obvious for you, but I come across many people who actually criticize the models for being simplifications, but they are simplifications by definition. I would also like to use the picture for the second point that it was already mentioned by the previous speakers. If you were a CAT modeling analyst, the most frequent question you would receive is whether a certain model is good or bad. But in the modeling world, good or bad is not a category. A model is either fit for a given purpose or not fit for a given purpose. So it's the purpose which determines whether a model is fit or not. And if a model is fit for one purpose, it doesn't mean that it's fit for all the other purposes. And in this connection with the model reliability, what is a catastrophe model actually? And we can understand a catastrophe model in this context as an extension of the historical event scenario method, where the history of events is smooth, interpolated, and to a certain extent extrapolated to cover a wide range of might have been events of a comparable realism. Now I get to my second topic, which should describe why and how did the models appear. The plotted graph shows the hurricane losses in the US. We are in the middle of 1980s. Behind us are 2 decades unusually free from major storms. And approximately at this time, a young woman at that time appeared on the scene. Her name was Karen Clark, and what she did is that she collected all the historical information about the hurricanes. She collected all the knowledge about the phenomenon and about the building stock. She packaged everything in a model, and this model of her predicted that the industry could suffer a loss of approximately $30 billion from a single hurricane, whereas the experience or the assessment based on the experience believed that a catastrophe event could only generate no more than a few $billion in losses. So actually the people were quite outraged. The response to her model was polite, and what she did is that she actually closed herself in the office and she further developed the models. But what she was really doing, without quite realizing that, was that she was waiting for a storm, and the storm came and struck the US in 1992, and it was Hurricane Andrew. It caused the insured loss of almost $16 billion. The economical loss was over $40 billion. 11 insurance companies went bust. And Hurricane Andrew was nowhere near a perfect storm. If it would have gone to Miami, it would have bankrupted the entire industry. So the Hurricane Andrew was a turning point in the culture of catastrophe. Straight after that, 3 commercial model vendors appeared on the scene. They developed and updated their models regularly, and over the years they also have become quite powerful. But even the most up-to-date models can miscalculate the loss from a storm, and the underwriters learned this the hard way in August 2005 when Hurricane Katrina struck the continent. This massive storm cost the insurers at that time over $41 billion, and the initial model estimates were about 1/4 of that. Simply, even the most updated models didn't include the scenario that the flood protection measures so far from New Orleans could fail, but they did. So what it teaches us that I think that the past, in connection with the nature of catastrophes, that the past is really an imperfect guide for the future. The catastrophes are simply too complex to be judged by human intuition. And the predictions of the most up-to-date models can be mistaken, but that's the nature of extreme risk, that it's sometimes mistaken. We need to do our best to limit the surprises and increase the preparedness, and that the models can help us a great deal. Just the last note related to Katrina, but also very interesting and important and related to how powerful the models are, is that straight after the Hurricane Katrina, the model vendors estimated the frequency of such a storm to be 1 in 40 years return period. 7 months later, they reevaluated their approach and increased the frequency twice within 7 months. So the insurance industry didn't have to raise those 40 billions to cover the losses, but additional 80 millions to keep up their solvency ratios. In early days of commercial cat modeling, we had the 3 model vendors. They were used to call the big 3, being RMS, AAR, and EquiCat nowadays CoreLogic. How does the situation look today? It's a bit more colorful, and this picture is not intended to be the full list. It's just to show you the perspective that there are many modeling solutions nowadays. Pretty much every insurer or reinsurer uses a model, and in many cases more than one. So having, and it was actually one of your questions, having so many options to choose from, how do I select which is the best fit for purpose solution for my portfolio and for my company? Well, I can offer you a similar answer as my predecessor, that during or over the last decades, a model build methodology was developed, and any qualified model vendor or model developer should follow this framework, and you have got the right as a model user to scrutinize pretty much every step in this model development process, and I advise you to do so. And a classical black box in the catastrophe modeling is nowadays a no-go. So ask the model vendors, how did you conceptualize the problems? What are the parameters in the models? How did you calibrate it? Where are the calibration tests? Which data did you use for validation, and so on? And this framework can help you eventually. I already mentioned that the catastrophe modeling is nowadays an industry standard. We use the models for the risk assessment, but there are also very important aspects which are sometimes overlooked, and I find that they are as important as the numbers that come out of the models, and that's the models actually created a certain discipline in the industry. They created a common currency to compare and contrast risks, to communicate and trade with partners. The models increase consistency when it comes to data capture and reporting, when it comes to the management of exposure and loss concentrations. Obviously, the rating agencies require the use of models in order to determine insurance companies' ratings. And even if you don't trust very much the modeling outputs, they create a benchmark for risk, which is also important because they enable you to take a position relative to that risk. And on our case, I would also like to demonstrate how they changed our role as a reinsurance broker from what was historically a linear process, purely transactional, where the risk identification and qualification was just one step in the transaction. It has evolved into an interactive, dynamic, and evolving process which in many ways hinges on CAT models and analytics. When it comes to the data management, when it comes to the portfolio management and portfolio insight, portfolio performance, when it comes to the model insight. So these analytical advisory services actually create values in contrast to pure transactional, which it was before. And now we get to my final topic, which is the model uncertainty. CAT model users between you know that the models from different vendors produce material different risk estimates for the same set of insured exposures, and we saw it in the previous presentations. Over time, the models have tended to converge, but there are still material, sometimes even very dramatic differences between the models. I also have got one example, which are the initial loss estimates for the Hurricane Harvey produced by the three major model vendors, and you can also see how much they vary. So in order to assess the uncertainty, I would like to present a study which was done a colleague of mine in the US, because a similar study hasn't been done in Europe, and because it was done in the US, it's focused on US hurricanes, but much of the same considerations may apply to other perils and in other countries, perhaps with even more force, because the US hurricanes are it's the most studied phenomenon, and it's covered by intensive studies and many decades of data. And very simply, this study shows that for a large nationally distributed portfolio of insured losses, the uncertainty around the estimates of high, more than 1 in 100 year return period losses amounts not to fractions but to multiples of the estimate. A 2 standard error interval crudely goes from 60 to 190% of the PML estimate produced by the model. And that's for the US hurricane and for the national portfolio. What we do nowadays is that we use the models which are designed for the risk assessment on the portfolio and on the national level. We use these models for the individual risk assessment, and this I see more often. But if we do so, we need to also understand that the uncertainty will increase significantly. So having all this uncertainty, how can we cope with it? And there are several approaches. In many cases, multiple models can be used to narrow the uncertainty band. One of the methods is blending, simply averaging the model outputs. But you need to be careful with model blending, because the model users tend to use the outputs of different models as a benchmark of models' uncertainty. It's quite natural to do so, but you need to understand that the models are not entirely independent. All the model vendors share the same data, they share the same sort of scientific knowledge. So be careful to use the multimodal techniques as a range of uncertainty. Another possible techniques are model morphing, where if you use one model output to reflect the characteristics of another model, or model fusion, where you actually use different components from different models effectively to build up a new one. Another important element in successfully coping with model uncertainty is to craft decisions that are robust with respect to the model error, and sensitivity or what if testings are the options. We as a company are industrializing this online, and this is our contribution to become more efficient in terms of knowledge transfer about the models. But successfully dealing with the uncertainty is a challenge, and it will require consideration and engagement from every group in the industry, including the model vendors, who need to lead the discussion about the uncertainty despite the comparative disadvantage of transparency. It needs to be the primary writers who need to be smart consumers of model outputs. Reinsurers who are already very advanced model users, but they shouldn't take advantage of this information as asymmetry, but rather lead the discussions which products make sense and which not. Rating agencies, regulators, everyone in the industry must give a helping hand, in my opinion. So with all this uncertainty, is there any certainty regarding the next large cat event? And I think there is one certainty. I think we can be fairly certain that the next large catastrophe event will be totally different from anything we have seen before. And that's the nature of extreme risk, that the predictions are sometimes mistaken. The important thing is that if the money is lost, it's not lost in an unearned manner, that it's not lost dishonestly or even unwisely, and that the models play a very important role to really increase the preparedness and limit the surprises. So I have got just a couple of conclusions based on what I said, and I think that the catastrophe modeling should not be used as a synonym for catastrophe management. Models are just tools in the risk management and risk selection process, and they help us understand the range of possibilities over the long term by creating a history that never happened. The foundation element of our industry is underwriting, and I think that your good underwriting judgment and experience is much more important than my modeling. Having said that, it needs to be mentioned that the underwriter must be empowered in this increasingly complex. If he wants to operate in this increasingly complex environment, he needs to be empowered. And in nowadays world, maintaining recognition of what a model can or cannot do is everyone's jobs. About the models themselves, they will develop. Even the most up-to-date models have a lot of space, a lot of room for improvement. But actually, the history teaches us that the major model improvements are usually driven by the catastrophe events. And this is it, and I will finish my presentation with the statement I used at the very beginning, which really, in my opinion, is worth emulating. And thank you.